Okay, so let's continue from where we left. Let's continue from where we left last time. Last time we were discussing a question. We were discussing a question on how to suggest a scheme of internal reconstruction. That's the question we were doing last time. We did not finish it, and so we want to complete that question now. We want to complete that question. Now, remember, it was a question whereby the examiner had not given us, in this topic of internal reconstruction, the examiner had not given us the scheme of internal reconstruction. I said we did a question, I think it was November 2016, which was giving us, that question gave us a scheme of internal reconstruction. Ours was just to implement the scheme by putting down the double entry. Then we developed the topic and went further and said, what if the examiner does not give you a scheme of internal reconstruction? In other words, you suggest one, you come up with a scheme of internal reconstruction. And I hope you remember, we went through the 4 steps of designing a scheme of internal reconstruction. We went through the 4 steps of designing a scheme of internal reconstruction. Of course, I hope you can see we did step number 1. We had to determine the loss to be written off. You can see it there. We computed the loss to be written off. And we saw the loss to be written off was how much? Was 427,500. That was step number 1. Then we went to step number 2. Somebody is saying you can't hear me. Are the others able to hear me? Somebody says he is not able to hear me. Are the others able to hear me now? I want somebody else to chat and say yes or no. Esther says he's not able to hear me. Are the others able to hear me? Are the others able to hear? You chat so that we know whether the problem is from which side. Are you able to hear me now? The others, you chat and say yes. Esther says can't hear you. What about the others? Yes, Helen can hear. Who else can hear me now so that we continue? Helen can hear. I can. James says, I can hear you. I can hear you. Good. Sawa. So the problem could be with Esther. I can, yes. So the problem could be with Esther. So maybe Esther should find out whether you are not put on the mic. Put on. Maybe you have switched on the mic. Find out. So I was saying, let's continue now. So once you did step 1, we said step 2 was to determine who among the stakeholders, I hope you remember, we said when a company is reconstructed through internal reconstruction, we said the stakeholders of the company are normally called into a meeting so that we find out who among these stakeholders should be requested to suffer that loss that we got in step 1. We said there is no way you can request somebody among the stakeholders of the company to suffer that loss if that stakeholder knows that if he goes to court and asks for the company to be liquidated, he will be paid what is due to him. Because we said, whenever a company is liquidated, normally assets are sold and liabilities are paid in order of priority. And so we are saying, if this stakeholder knows, could be ordinary, could be its preference, could be its debenture holders, if he knows that he can go to court and ask for the company to be liquidated and he will be paid, then there is no way, we said, you can request him to suffer this loss of 427 in the reconstruction process. Because he will be saying he's better off the company being liquidated than being reconstructed. So who is to suffer this loss? We said it is only that stakeholder. Listen, it is only that stakeholder who, even if he goes to court and asks for the company to be liquidated, assets will be sold in a particular order. Assets will be sold and liabilities will be paid in a particular order. And by the time the money is finished, that guy will not have been paid if the company is liquidated. So it is that person that we said you go back to and ask him. Because even if you go to court and ask for the company to be liquidated, you will still lose. Why can't you accept to suffer this loss of 427,500 with the hope that we shall make profit in the future and you will be able to participate in that profit? So to determine that stakeholder, that's why we said you go to step number 2 now, where we said you prepare. Step number 2, we said you prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is liquidated. Prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is liquidated. I told you, we are not liquidating the company. We are reconstructing the company. So we said you prepare a distribution statement of the sales proceeds on the assumption that the company is liquidated. So you can see we did that in step 2. I don't have to go back. We prepared that step 2. We kept paying the liabilities in order of priority. We kept paying. And when we came to almost the end, we remained, after paying, I can see here, after paying the preference shareholders their capital, we remained with a balance of 22,500. And whatever balance remained, I told you, after everybody else has been paid, even the preference shareholders, the money that remains normally goes to the ordinary shareholders. And that's what we paid them. And money now got finished. Then once we did that, we asked ourselves, who among them? We saw for the preference shareholders, we owed them 300,000. If they went to court, they will still be paid what is due to them. We can see from the statement, they will be paid this 300,000. Then we saw that means they will lose nothing. But if the ordinary shareholders go to court and ask for this company to be liquidated, yes, from our balance sheet we saw we owed them for 50. But if they go to court and ask for the company to be liquidated, from our step 2 there, we have seen they will only get for 22,500. They will only get 22,500. So it is obvious that even if they go to court and ask for this company to be liquidated, they would still lose that for 27,500. They would still lose that for 27,500, which is exactly what we saw in step 1. And so we concluded, we concluded from this step 2 that it is the ordinary shareholders who should be requested to suffer the loss in step number 1. After all, even if they go to court, they will still lose. So we ask them, please accept to suffer this loss with the hope that we shall make profit in the future and you will be able to participate in that profit. Good. Once we concluded that step 2, now we had to go to step 3. Step 3, we said, you determine the loss reduction per share. You determine the loss reduction per share. How? We said you take whatever is the total loss, you divide that by the number of ordinary, because now we are dividing, we are reducing the amount on the ordinary. So we said you divide that by the number of ordinary shares. From this question, we are requesting them to suffer a loss of 427,500. From this question, we went to the balance sheet and we saw they have 45 million shares. So we saw that the company should request the ordinary to suffer a loss of 9.5. That was our step number 3. Then we went to step number 4 now, where we had to suggest a scheme of internal reconstruction. I told you, the first thing to put in the scheme is anything you got in step 3. What did we get in step 3? Ordinary shares to be reduced by how much? 9.5. So that's what we agreed, 9.5. Ordinary shares to be reduced by 9.5. Step 2, or what we said under number 2, the second, the third, the fourth, the fifth item that will be in the scheme, how do we identify them? I hope you remember, we said to identify other items to put in the scheme, I told you, go back to step number 1. Go back to step number 1. I told you, anything that you used in the determination of the loss to be written off, that which you used should be part of the scheme, should be part of the scheme. So you remember we had to revalue some assets, some gave us a gain, some gave us a loss, and so on. And so we had to do that now. And so in our scheme, we said, number 2, assets to be revalued to their fair values as follows. You can see land, building, furniture, motor vehicle, inventory, trade receivables. Good. Number 3 item we saw, which I don't have to go back, we said goodwill is considered to be valueless or worthless or valueless, and therefore should be written off. That one we were given in the information question. Number 4, reconstruction cost of 4.5 million. Our figures were in thousands, so we were putting it 4,500 is to be incurred. Number 5, we saw accumulated losses to be written off. Number 6, preference dividends in arrears to be paid in cash. And number 7, we saw revaluation reserve to be written off. Those are some of the items we came up with the scheme. How to come up with them? Of course, we discussed them in a previous class. I don't have to go back into the details. Good. So let's continue now. So we want to do part B of the question. Number B of the question was asking us to implement the scheme of internal reconstruction. Now, before we continue, there are some new students who have joined us because today is a free class. Now I want to listen. In case you are disconnected, some students, I'm talking to the new ones, in case you are disconnected when you are watching a live video, like this one now, sometimes you may be disconnected because of your Wi-Fi strength being weak. So how do you come back to class? I'm talking to the new students. There are 2 other ways you can come back to class. You may try to click back the disconnected video and it doesn't bring you back to class. So there are 2 other ways. 1, you can refresh the page from which you are watching the video from. That page you are watching the video from, you can refresh it. Normally, on the top left or on the top right of the page, there is always a refresh button, meaning you can refresh the page. If your gadget does not have the refresh button, then the other way to come back to class is to click on the link that was sent to the group. From where you received the link, you go back and click the link again. Those are other 2 ways in which you can come back to class. Okay. For all the students now, if maybe, let me ask, if you have not subscribed to my YouTube channel, please subscribe. If you have not subscribed to my YouTube channel, please subscribe. Just click on that subscription button below there and click on the notification bell, especially for the new students, so that you get notified whenever we post videos to our YouTube channel. There are sometimes we post videos for free. You will be notified. So anybody can subscribe. Even if you are an old student, please subscribe to my YouTube channel. Just click down there. There is a subscription bell button. Click it and also click the notification bell. Good. So now we can continue. So let's continue now. So we want to do part B of the question. So let me project it now and we see what was it asking us to do. What was part B of the question asking us to do? You can see it down there. The question told us, number B, we prepare a capital reduction account. account. So let's prepare that account. Let's prepare that account now. In other words, what we are trying to do is to implement the scheme of reconstruction. What we want to do is to implement the scheme of internal reconstruction. So let's open that account. We are doing part B of the question by opening an account called capital reduction. In other words, we are trying to implement the scheme that we have just designed. We have designed a scheme of internal reconstruction, and therefore we want to implement it. We want to implement it. Good. So let's go back to the items that we have put in our scheme one by one so that we implement them now. Number 1 says, ordinary shares to be reduced by, our number 1, ordinary shares to be reduced by 9.5 per share. Ordinary shares to be reduced by 9.5 per share. Now, I don't have even to calculate it. Let me take you back. When we were doing step 3, we said determine the loss reduction per share. We saw the total loss was 427. We divided that by the number of shares, 45,000. We got an amount of 9.5 per share. So step number 1 or item number 1 in the scheme says ordinary shares to be reduced by 9.5. So it means we are taking that 9.5, multiplying by the number of shares to get the amount to write off. You take the amount to be written off per share, you multiply that by the number of shares. Our number of shares were 45,000. So it is obvious, if you take 9.5 and you multiply by 45,000, you will still get this amount we are getting as 427,500. You still get that amount we are getting as 427,500. Okay? That's what we are saying. So it means we don't have to go back to the question so that we know how much write-off in total. No. If we are writing off 9.5 per share, and we had 45,000 shares or 45 million, we know that if I take 9.5 multiply by 45,000, that automatically will give me 427,500. That will give me 427,500. Good. So let's do that. We want to write off 427,500. From where? From the ordinary shares. How do you write off? We said you debit share capital and you credit capital reduction. Good. So open, we have already opened this account. So come to this account and you credit and you say your ordinary share capital. We are writing off how much? 427,500. 427,500. That is the amount we are writing off on ordinary shares. That was number 1. Number 2, item in the scheme. That's what we want to go back to. What is it requiring us to do? What is number 2 item requiring us to do? We have agreed just a short while ago. Number 2, assets to be revalued to their fair values as follows. Assets to be revalued to their fair values as follows. Land, 777, furniture, 435, motor vehicle, 45,000, inventory, 210, and trade receivables, 939. 939. Listen, we don't need to go back to the question to find out how much we are writing off or reducing assets by or increasing by. Like, for example, we are revaluing the asset called land and buildings to 777. If you remember, when we were doing step number 1, we had to revalue the assets. Some of them gave us a loss in terms of decrease in value, and one of them gave us a gain in terms of land. So if you remember note number 1, step number 1, if I may take you there, here it was. You can see down here, among the gains that the company would have made in the process of reconstructing the company was this gain. The land was increasing in value. From the balance sheet, the value of the land was 720. But we were told by the additional information, the fair value of the land is 777. And so we concluded, if after reconstruction, the asset will go back to the books at 777, but before reconstruction, the asset had a book value of 720, then we made a gain of 57. That's what we are saying. Otherwise, for the rest of the assets like motor vehicle, furniture, and so on, which we are given in step 2, all of them, I can see here, they gave us losses. That means there was that decrease. For example, if you look at furniture, in the balance sheet, it had a book value of 435. But the fair value under the note 2, under our scheme, says machinery or furniture to be revalued to 480. So if it was revalued to 480 and it had a book value of 435, then it was losing 45. Furniture, that's okay. Motor vehicle. From that number 2 in the scheme, we say the assets to be revalued to their fair values as follows. We were given the fair value of the motor vehicle as 90. So if the fair value was 90, and in our original balance sheet, the book value of the motor vehicle was 45, then we saw furniture, motor vehicle, will lose 45. That's a loss. The other asset we revalued was inventory here. According to our item 2 in the scheme, which we are trying to implement, we are told the fair value of the inventory was 210. But its book value, its book value was 240. Its book value was 240. That's I think I'm even confusing, because I'm saying the furniture book value was 480, fair value 435, a loss. Motor vehicle book value was 90, fair value was 45. Inventory book value was 240, fair value was 210. So if it had a book value of 240, that is inventory, and the fair value was 210, that's another loss of 30. Trade receivables book value was 1020, but the fair value was 939. That's another loss of 81. So those are the assets we revalued in our item number 2 in the scheme. You can see here assets to be revalued to their fair values: land, furniture, motor vehicle, inventory, and trade receivables. So let's implement our step 2 now in the scheme. Let's implement our step 2 in the scheme now. We want to implement our step 2 in the scheme, which says what? Our item 2 in the scheme says assets to be revalued. So let's revalue those assets now. Let's revalue those assets now. Land, of course, we have seen it is a gain of 57. I hope you can remember in step 1 here. Land was a gain of 57 DOE. So let's increase the value of the land by 57. How? You debit land and you credit what? You debit land and you credit. You debit land and you credit capital reduction. So let's do that. We debit land and we credit capital reduction. So let us debit land and credit capital reduction. And you come and see a land and buildings. We revalued land and buildings to its fair value and it went up by 57. It went up by 57. Good. So finish. We go to the next one. After land, what was the next one they were telling us to revalue? The next asset was furniture. What was the loss? We got it in step 2. In step 1, furniture, the loss is 45. I hope you can see it there. We are reducing our furniture by 45. It's an asset. Credit the asset, you debit capital reduction. So let's do that. Our furniture is reducing by 45. We debit capital reduction. We credit furniture by 45. Next one, I've forgotten which asset it was. Under step 2, under item 2 in the scheme, after furniture, it's motor vehicle. And I think the loss was 45 again. Let me confirm from step 1, motor vehicle, yes, the loss is 45. That's what we are reducing by. So we credit motor vehicle, we debit capital reduction. Let's do that. We come and see a motor vehicle. Motor vehicle is losing another 45. Good. After motor vehicle, what other asset did we revalue? According to our scheme, we revalued inventory. Again, it was a loss. If I'm right, I think it was a loss of 30. Let me confirm. I think it was a loss of 30 in step 1. Yes, inventory, it's a loss of 30. We credit inventory, we debit capital reduction. We come and say here, inventory, that is 30. That is the other item we are revaluing. After that, we also revalued another asset called what? In our second item in the scheme, good. The last one is trade receivables. And trade receivables, I think it was a loss of how much? Let's go back to step 1. What did we get as the loss of the trade receivables? Good. Here, 81. We had to revalue downwards by a loss of 81. So let us credit trade receivables and we debit capital reduction, and we come and say trade receivables 81. So we have done our second item in the scheme, which says assets to be revalued to their fair values as follows. One asset called land gave us a gain, and the other remaining assets gave us a loss. So any increase in value of an asset, we normally debit asset, credit capital reduction. With any decrease in value of an asset, you credit the asset, you debit capital reduction. So we have implemented our second item in the scheme. What was the third item in the scheme? Number 3 said what? Our number 3 says goodwill is considered to be valueless and should therefore be written off. So if you don't have to go back to the balance sheet, we did that in step 1. We did that in step 1 where we saw goodwill was to be written off, and so it was part of the loss to be written off. And how much was the goodwill? From that step 1, our goodwill loss was 60,000. You can see it there. We wrote off goodwill of 60,000. It was valueless. So it means originally it had a book value of 60. It is considered to be valueless, meaning it will not go back to the books. So it has to be reduced by 60. So I am crediting the goodwill account to write it off, and I debit capital reduction. Good. So put it, and we come and say a goodwill. That is 60. Good. After writing off goodwill, what else did we do? We are through with step 3 in the scheme. What was the fourth item in the scheme? The fourth item you can see says reconstruction cost of 4.5 million. Our figures were in thousands, so that's why we wrote 4,500 is to be incurred. And I told you, remember, listen, we said when we were discussing the double entry, I told you with the reconstruction cost that you're incurring, it is a loss to the company. In the process of reconstructing the company, we are spending 4.5 million to reconstruct the company. And so we had to ask ourselves, is that a gain to the company or a loss to the company? Listen, just to remind you, when we started the topic, I gave you 6 official accounting entries for internal reconstruction. Of course, I hope you remember number 1, we said with amount written off on share capital. Number 2, with amount written off on liabilities. Number 3, with amount written off on assets. Number 4, I told you with accumulated losses written off. Number 5, we said with any contingent liability arising. Then number 6, and the last one we said with the balance in the capital reduction account. That balance should be considered as a capital reserve. Then I took you through and we said there are times when the examiner may give you a transaction which is not among the 6 official entries that we had to use in the reconstruction. But then, before we concluded whether to debit or credit, listen, we went through the entries again last time and we saw a pattern. And every time the company was being reconstructed and the company seems to make a gain, that gain, you remember, we saw it was being credited in the capital reduction. Then we analyzed and we saw also, any time it seems a company makes a loss in the process of reconstructing the company, we saw that loss was being debited in the capital reduction. Okay? Then I told you that sometimes you go to the exam and you find there is a transaction given to you which is not among the 6 official accounting entries. But in the process of trying to implement that transaction, you realize that in the process of trying to implement it, our company will suffer a loss. And so we concluded that loss should be debited in the capital reduction account. Then we said, if an examiner gives you another transaction by whatever nature, but in the process of analyzing that transaction, you realize that by implementing that item of the scheme, the company will gain. So we concluded, any gain that was made or is made in the process of reconstructing the company, that gain, we concluded, should be credited in the capital reduction. That was what we saw. Okay? So now we can see our fourth item in the scheme here is reconstruction cost to be incurred. It's not among the 6 official entries that we normally use when you are implementing or dealing with an internal reconstruction question. But we saw what effect would it have when we incur a reconstruction cost of 4.5 million. Are we making a gain as a company or are we making a loss? We saw it's a loss. So let's implement and recognize a loss of 4.5 by incurring that loss. So we said you debit capital reduction and of course you credit bank. You debit capital reduction, you credit bank. We are told we incurred 4.5 million to be incurred as a reconstruction cost. Good. So come and debit here and you say bank, put in bracket reconstruction cost so that you remember our figures is 4.5 million and because our figures were in thousands, so we put it as 4,500. Now, listen, I want to mention something again. I want to mention something there. In this question, bank was affected somewhere. You remember somewhere we were told in our scheme, preference dividends to be paid in cash. And don't forget, in our question also, we are being asked to prepare a balance sheet after reconstruction. So some of the accounts we shall need to balance. And like now bank has been affected, and I know it will be affected again, so I need to balance that account. So let's balance, or let's open the account called bank. Let's open an account called bank, because I know one of the items in the scheme, we shall use cash, where we were saying preference dividends to be paid in cash. Now that we have paid our reconstruction cost of 4.5 million, then we are debiting capital reduction. Let's credit bank. But before we credit bank with that 4,500, let's bring down the original bank balance. Let's bring down the original bank balance. And from the original balance sheet, what was the original bank balance? Let's go back and find out what was the original bank balance. We want to pick the balance of the bank. Among the current assets, I can see the last one up there was trade receivables, no bank. But if you look down here, among the current liabilities, we have a bank overdraft of 500,000. We have a bank overdraft of 500,000. We bring it down. To bring down that overdraft, bring down that bank overdraft of 500,000. We come and say your balance brought down 500,000. We have our debited capital reduction Now we can credit bank, and you come and see here, capital reduction. Maybe you can put in bracket reconstruction cost, just to remind you what it is, 4,500. So we have implemented that item in the scheme, which says reconstruction cost of 4.5 million to be incurred. Reconstruction cost of 4.5 million to be incurred. Good. We now move on to the next item in the scheme. And what is it about? We are through with number 4. Number 5 says accumulated losses to be written off. Accumulated losses to be written off. Of course, I know you still remember, we said losses are always a debit balance. Losses are always a debit balance. So if you are to write them off, we said you will credit that P&L account. Losses are always a debit balance, so you go write it off by crediting the P&L account, and we said you debit capital reduction. I don't need to go back to the balance sheet. We can pick the amount from step 1 because it was part of the scheme. I can see it here. The second item is this accumulated losses of 415. Those are the ones I'm trying to implement to be written off. So let's recognize that loss. We credit P&L account, we credit P&L to write it off, and we debit capital reduction. So come and see your P&L account. That's an amount of 600 and what? 15. 615. Good. We are through with that item in the scheme. Next one. What's the next one after that? That's not number 5. We go to number 6. Now. Number 6 item in the scheme says, preference dividends in arrears to be paid in cash. Preference dividends in arrears to be paid in cash. I want you to listen carefully. If you remember, last time when we were discussing this topic, we said preference dividends in arrears don't appear in the balance sheet. If you go to the balance sheet of this company, you will not see that amount as a liability. Yet we have not paid the dividends for the last 2 years, I think, in this question. And so we said preference dividends in arrears is an example of a contingent liability. It's an example of a contingent liability. And so we say, because it does not appear in the balance sheet, any contingent liability normally doesn't appear in the balance sheet. But now we are being told to pay it in cash. So if you pay in cash, it's true, you will credit cash. Which account will you debit? And so we said, I want to listen carefully. We said, in the process of reconstructing a company, whenever you realize that the company has a contingent liability, whichever it is, that contingent liability, we said, should be crystallized. You are reconstructing the company. This company has a contingent liability. I have told you, contingent liabilities don't appear in the balance sheet. But now that we are reconstructing the company, you are required, we said, you are required to crystallize that liability. Make it as a liability. Once you make it a liability, we went further and said, if it is paid for immediately, then you will debit that contingent liability, then you credit bank or credit cash, whichever it is. So for this number 6 item, listen, for this number 6 item, the examiner wants you to still remember that preference dividend in arrears is an example of a contingent liability. And in our balance sheet, we don't have a liability called preference dividends in arrears. But we shall have to pay it. So what do you do first? Before you pay it, listen, before you pay it, we said you have to crystallize it and make it a liability. That's important. how do you crystallize that liability? We said in this topic of internal reconstruction, to crystallize that liability, we said you debit capital reduction and you credit that contingent liability. So let's do it now. So come and say here, debit capital reduction, and you credit this account we are calling preference dividends in arrears. We debit capital reduction and you credit preference dividends in arrears. How much was the arrears? We got it last time to be how much? When we were doing step 1, we had to calculate the amount of the arrears. And I can see here, we saw the preference dividends were earning a rate of 9%. The share capital on preference was 300 million. For 2 years, we had not paid, and therefore we had an amount owing of 54 million, or in other words, 54,000. So let us debit that capital reduction and we credit our contingent liability to make it a liability. But now that we know the specific name of our contingent, which is preference dividends in arrears, we debit capital reduction and we credit preference dividends in arrears. Good. For the sake of seeing the complete double entry, just open another one line now. Just open another one line account, call it preference. Open another one line account, call it preference dividends in arrears. Preference dividends in arrears. Preference dividends in arrears. We have debited capital reduction. Now come and credit here, and you see your capital reduction, and that is 54,000. I think it's 54. Yes. So what we have done, listen, what we have done is just to crystallize that liability, to crystallize that liability. Now we want to pay it. According to our scheme, we agreed preference dividends in arrears to be paid in cash. Preference dividends in arrears to be paid in cash. That's what we have just seen in our scheme. Now that we have crystallized it, and that was a small trick, that you could not pay something that you don't have. Now we have it. By crystallizing it, now we have it in our books. We have debited capital reduction. Now we have credited contingent liability. Now we can pay that liability. So let us debit contingent liability, which now we know is preference dividends in arrears, and credit bank. Cash and bank are synonymous, which is 54,000. We are debiting our preference dividends in arrears and crediting bank. So come and credit bank, and you say your preference dividends in arrears. Preference dividends in arrears, and that is 54,000. Good. That is 54,000. So we are through with that item of the scheme. We are through with that item of the scheme where they required us to pay our preference dividends in arrears in cash. But I said it was a bit tricky first because you had to first crystallize that liability. You had to first crystallize it. Before you pay it, we had to crystallize it. Good. Now we can go to the next item in the scheme. And after that, what came next in the scheme? Good. The last one. The last one says revaluation reserve to be written off. Revaluation reserve to be written off. I don't have to go to the balance sheet to get the amount. Of course, you remember we used it in step 1. We said any gain by you writing off revaluation reserve, as a company we are gaining. And so we saw among the gains we shall make in the process of reconstructing the company was that revaluation reserve, which was to be written off. And so we can go and pick it from step 1. We did use it. We used it. Down there, I hope you can see among the gains, there is that revaluation reserve, which we saw to be written off, and the amount was 450,000. 450,000. Good. So that's what we want to write off. As per the scheme, it says revaluation reserve to be written off. Good. Now let's go right off. I know you know, and we said revaluation reserve is a credit balance. It being a credit balance, to write it off, we said you debit that revaluation reserve and you credit capital reduction. So come and say a revaluation reserve. Revaluation reserve, That is 450,000. Good. So we have implemented our scheme of internal reconstruction as per part A of the question. So part A told us to design a scheme which we designed last time. Today, part B is saying we prepare a capital reduction account. In other words, they are saying we prepare or we implement our scheme, which we have done. Listen. So before we go to part B of the question and part C and prepare the balance sheet, listen to this now. We said, after you have implemented the scheme, you need to check whether this capital reduction account has a balance. I told you, we normally use this capital reduction account to help you implement the scheme, to help you implement the scheme of internal reconstruction. So there are times when the account may balance, or there are times when it doesn't balance. If it doesn't have to balance, we say that balance is considered as a capital reserve. So I want to confirm whether our capital reduction account has a balance. So let me confirm. I am adding the items on the debit first. 45 plus another 45 plus 30 plus 81 plus 60 plus 4,500 plus 615. This is 615. That is 615. Yeah, for the accumulated losses, 615 plus 45, 54. On my debit side, I can see a total of 934, 500, 934, 500. What about on the credit side? What do we get as the total I'm adding? 427, 500 plus 57,000 plus 450,000. That looks like another 934, 500. So it looks like our capital reduction has balanced. There is no balance. In fact, it is self-balancing now. Good. So let's close that account. That is 934, 500, 934, 500, 934, 500. So the only account I need to balance is bank, so that I know what balance are we taking to the balance sheet for bank. This is 500. I am adding the bank plus 4,500 plus 54. So we are carrying down a balance of the bank. Balance carry down. I am carrying down 558, 558, 500, 558, 500. Good. For the preference share, for the preference dividends in arrears, there is no balance. We just close. So we are through with part B of the question. We are through with part B of the question, which was asking us to implement the scheme that by preparing a capital reduction account, So we want to go to part C of the question now. So finish. We want to go to part C of the question, and what is it asking us to do? That's what I want to confirm. What is part C of the question asking us to do? So let me roll the question and we see what is it asking us to do. Number C is asking us, we prepare an opening balance sheet as at 1st April 2008 after the conclusion of the scheme. So we are required to prepare an opening balance sheet. Listen. For now that we are required to prepare balance sheet, listen now. It is obvious now you have almost everything. Why? You know the amount you wrote off on share capital. You know how the assets were revalued. So you can go pick all those assets. Now listen. What you need to do when you are required to prepare the balance sheet, you go back to the original balance sheet and find out which assets did we have and whether it was affected in the reconstruction. There are some which may not be affected. There are some which may be affected. in the reconstruction process. If it was affected, bring it back at the revalued amount. If it was not affected, whether an asset or liability, bring it back at the original value. So we want to go back to the balance sheet originally and ask ourselves, which assets did they have? What effect did it have on the reconstruction? Was it written off? Was it revalued? Blah, blah, blah. Whatever it is. Good. So from the original balance sheet, what are the assets and the liabilities now? For example, listen, if I can take you through, among the fixed assets, which are non-current asset, you remember land was revalued. So we shall just pick the value of the land. Furniture was revalued. You remember? Motor vehicle was also revalued. Goodwill was considered to be valueless. So we wrote it off. It will not be there. Next, among the current assets, I can see inventory. I remember it was revalued. Trade receivables, it was revalued. Then, from there, listen, I cannot see bank account, but originally bank was an overdraft. Listen, but there are times when, after you have implemented the scheme, the bank could turn to be an asset or still remain an overdraft. Like in our case now here, it looks like our bank is still an overdraft. It looks like our bank is still an overdraft. So now it means we can implement part A of that balance sheet. That means we know the assets and we know how they were revalued. How are they revalued? We can just pick them from our item 2 in the scheme, where we saw assets to be revalued to their fair values as we have land 777, furniture 435, motor vehicle 45, inventory 210, and trade receivables 939. So we are just copying those figures. So let's do it. Let's do it. So we are preparing an opening balance sheet. Now let's call it statement of financial position. Statement of financial position. We start with non-current assets. One of the first one, I think, was land and buildings. Let me confirm. Yes, land and buildings, 777. Land and buildings, 777,000. Good. After land and buildings, the next one was furniture. What was the value of the furniture? We have just revalued a short while ago from step 2, from item 2 in the scheme. Furniture is 435. Bring it. Furniture, we revalued it to 435. Good. After furniture, we go to the next one. Originally, there is motor vehicle. We revalued it also to how much? We go pick it from note number 2 in the scheme, from item 2 in the scheme, and motor vehicle was revalued to 45. Pick it. That is 45. This is motor vehicle, 45. I think those are the only fixed assets. Goodwill, you remember, was written off. Goodwill was written off. So we no longer have it. From there, we now go to current assets, which we have also seen. And the only current assets include inventories, inventory and trade receivables. There was no cash because I told you bank is still an overdraft. So let's go pick the value of the inventory now. Let's go pick the value of the inventory from our item 2 in the scheme. What was it telling us to revalue the land of the inventory to? We revalued our inventory to how much? To 210. Put it 210. Then finally, we revalued our trade receivables to how much? I should have just picked it, but how much is it? Trade receivables, 939. Good. Pick it. 939. So we get the totals now. We get the totals of the assets now. Our total assets will be 777 plus 435 plus 45 plus 210 plus 939. 939. I'm getting a total of 2,406,000. 2,406,000. 2,406,000. Good. Now we can go to the second part of the balance sheet now, and that's what we normally call the equity and liabilities now. Equity and liabilities. So let's go back to the original balance sheet. Among the equities, was there anyone which was affected? If it was, we change the amount. If it was not, it goes back as it was. Good. So let's go back to the original balance sheet. Among the equities down there, we have ordinary share capital. That's the first one, which was originally for 50. Share capital called ordinary, originally for 50. But I hope you have not forgotten our first item in the scheme, ordinary shares to be reduced by 9.5. So in total, we wrote off 427 what? We can go back to the capital reduction. We wrote off 427,500 here. That's what we wrote off on share capital called ordinary, 427. Originally, I can see in the balance sheet, it was 450. Now we reduced it by 427. So we come and bring the new balance of the share capital. So we come and say ordinary share capital. We did not need to open the account, so you can just put in bracket 450,000 minus 427,500. That, of course, will leave us with what we were getting as 22,500. That's what was remaining. If you write off out of 450, if you write off 427,500, you will remain with 22,500. Good. Next one, we go back to the next item in the balance sheet. After share capital called ordinary, I can see we have a 9% cumulative preference share capital worth 300. Listen, that share capital called preference, we have not affected it. Listen, there is nowhere in our scheme we have said preference share to be reduced by this. No. So our preference shares will not be affected by the reconstruction, so they will go back as they were. We come and just say a preference share capital. And our preference share capital goes back as how much? 300,000. Good. Bring it. It was not affected anywhere in the scheme of reconstruction. B. Next, after share capital called preference, what's the next item in the balance sheet? I can see the next one is a revaluation reserve. That's the next one. I hope you remember, we have just said the last item in our scheme, that reserve called revaluation to be written off. So we no longer have it. So it will not go to the new balance sheet. We wrote off the revaluation. Next one is profit and loss. That accumulated loss, remember we wrote it off. Good. So among the equities, it looks like I'm only remaining with ordinary and I'm remaining with preference share capital. Listen, for this question, our capital reduction account did not have a balance. I told you, if there was a balance, I would have called it capital reserve, which means I would have brought it among the equities. But for this question, our capital reduction account was self-balancing. Because it was self-balancing, we did not have any balance. Good. So it looks like we are through with the equities. Now we can go to liabilities. Among the liabilities, we can start with non-current liabilities. We go back again to the balance sheet. Among the long-term liabilities, which ones do we have? And was it affected? That's what we want to do. We go back to the balance sheet and check what do we have. And if you look at down there, the balance sheet, among the non-current liabilities, this company had only one of them called 10% debenture amounting to 500. And of course, there is nowhere in the reconstruction. There is nowhere in the reconstruction process where we have said an item in the scheme that we write off or pay off the debentures. No. Good. So we can go back, and it goes back as it was, 10% debentures. And the amount of the debenture, which is at 10%, is 500,000. This is 10% debenture. 500,000. Listen carefully again. I hope somebody will not ask me, listen, we paid it in the liquidation. When we were doing step 2, here, when we were doing step 2 in the reconstruction, we said, in case the company is liquidated, prepare a distribution statement of the sales proceeds showing how the liabilities will be paid in order of priority. We said, it's true, we had these debentures on a floating charge, we had this, but don't forget, that was in case the company is liquidated. We were not liquidating, or we are not liquidating, we are reconstructing. I've been asked that question before, but why are we bringing back the credit, the debentures, yet it was paid in the liquidation? I have said, step 2, we were only using that step 2 in our 4 steps, just to know who among the stakeholders of the company should suffer the loss in step 1 in the reconstruction process, not in the liquidation process. No. So we were using step 2 just to help us to ask ourselves, who is this stakeholder who, even if he goes to court and asks for this company to be liquidated, this stakeholder would still lose? Who is this? And from that working, we saw it was the ordinary shareholders. Are you there? Good. So our step 2, we are not liquidating. We are just assuming on the assumption. So we have not paid our bank overdraft. We have not paid our debentures, no, because we are reconstructing the company. We are not liquidating the company. But we are to assume, suppose the company is liquidated. And the purpose of us assuming that is only to help us to know who among the stakeholders should suffer the loss in step number 1. Are you there? Good. Fine. So now we can continue now. Now we can continue. So I hope you have understood that we are bringing back our debentures. Why? Because they have not been paid at all. Good. In the reconstruction. Good. After that, I can't see any other long-term liability according to this balance sheet. So we go to current liabilities now. We go to current liabilities now. Among the current liabilities, which ones were there and were they affected? The first one there is bank overdraft. Yes, bank overdraft was affected because we paid some more amounts in cash. You remember our preference dividends in arrears were paid in cash. We also had to spend reconstruction cost or whatever. So let's go and pick from the question, from our workings, what did we carry down? What did we carry down as our bank overdraft? And I can see we carry down a bank overdraft here of 558, 500. 558, 500. So bring it. So you come and see a bank overdraft. And the amount is 558, 500. 558, 500. Then we go to the next one. The next one is creditors. The next one I can see down there is creditors. Were they affected? No. Were they affected? I am not saying in the liquidation. I'm talking of reconstruction. There is nowhere among our scheme, those 7 things we have said, that creditors to be paid. No. So don't ask me again, but you remember, we were told the preferential creditors were paid, blah, blah, blah. No, that was only to, in case the company is liquidated. Okay, but we are not liquidating. So our 4 steps, step 2 was only an assumption that suppose the company is liquidated. So that was only a small part of the whole picture. So it should not confuse you. Good. So we are going back and saying, in the reconstruction, is there anywhere we affected our creditors? No. Among the items we have implemented in our scheme here, number 1, ordinary shares to be reduced by this. 2, assets to be revalued to their fair values. 3, goodwill is considered to be valueless. 4, reconstruction cost. 5, accumulated losses. 6, preference dividends in arrears. 7, reserves to be written on. There is nowhere we have said creditors to be paid. No. But when you assuming, suppose the company is liquidated, there was a preferential creditor and there were no more other creditors. But for now, as per the reconstruction, we are not paying them anything. Good. So we take it back as it was. Our trade payables are 1025. Good. So let's take them back to the balance sheet as they were. Creditors. That is 1025. That's all. Let's see whether the balance sheet will balance now. Let us add the equities and the liabilities now. We add the equities and the liabilities, 22,500. That is ordinary. Preference share capital 300 plus debentures 500 plus bank overdraft 558,500 plus creditors 1025, and the amount is getting us an amount of 24. I'm getting 2406. Let me confirm whether it's agreeing with the asset side. Oh yes, good. Seems to agree. Fine. So finish. We are through with part C of the question now. There is one more part remaining. There is one more part remaining now. To finish, I want to discuss the last part. There is one part the examiner was asking us to do, which has nothing to do with the reconstruction. It's just a formality that they just added another question there. So let's go back and read it. So finish, for those who are still copying. Finish for those who are still copying. Okay. Now listen. Let's go and find out what is part C of the question asking us, part D, sorry. What is part D of the question asking us to do? Number D, they are saying, if you read there, a statement showing how the anticipated profit under the new arrangement would be distributed to the various providers of capital. Let me take you to the start of the question so that I can see. You can see up there, third paragraph at the start. Third paragraph, after based on, it says, it was anticipated. That's where I am. It was anticipated that after reconstruction, the company would make an annual profit before tax and interest, before interest and tax of 300 million. The tax rate was estimated to be 30%. So now listen. We have just prepared our balance sheet, and this is the balance sheet, listen, first day after reconstruction. Meaning it is the opening balance sheet. We expect, listen, we expect that our company from this year onwards will make a profit of 300 million, which is our profit before interest and tax. Profit before interest and tax of 300 million. You are being asked, don't write, you are being asked, show how this profit will be distributed to the various providers of capital. Show how this profit will be distributed to the various providers of capital. Now, it is obvious they just wanted you to complete, listen, they just wanted you to complete the income statement. These guys prepared the income statement, they got the GP, they had to minus expenses, then they got this profit before tax and interest, before interest and tax. Now listen, if our balance sheet day one is this, and now this is the profit we expect to make, we all know, listen, after the company has paid as charge expenses and they're remaining with interest, profit before interest and tax, the first thing to minus there is interest. Listen, our company here has a 10% debenture. So if this is the position on day one, that our company has a 10% debenture, whose amount is 500,000, it means that this year we shall have to pay, or we shall have to incur interest of how much? 50,000. 10% of 500 is 50,000. So that is the first item we shall appropriate out of the 300 million. So we shall pay interest of 50. After we have paid that, we shall remain with what we are calling profit before tax, which is how much? 250. Once you get the profit before tax, you come and get tax. We are being told by the question up there, you remember, the tax rate was 30%. So what is 30% of 250? %30 of 250, it is 75. If I minus that, listen, I am remaining, don't write, I'm only first explaining. You remain with what we are getting as the profit after tax, which is looking like another 175, profit after tax. Then from there, listen, we are supposed to pay dividends. Listen carefully. We are supposed to pay dividends to the shareholders. Our company had a 9% preference share capital. But I've not written the percentage here, but I do remember it was 9%. Every year, preference shareholders are normally entitled to a fixed return in form of dividends. So it is obvious that our company, having made a profit now, from this year onwards, we shall be paying them how much? Every year, 9% as dividend. What is the capital? 300,000. So 9% of 300,000, it's obvious that will be 27,000. So you come and pay out of the profit after tax. You know it's preference shareholders who are normally paid their dividends first. You came and said here, preference dividends. That is 27, which is 9% of 300,000. That will leave me with how much? That looks like 8. That is 6, 4, 1. 148. Listen to me now. That 148, everybody knows by now. After you have paid the debenture holders their interest, you have paid the government their taxes, you have paid the preference shareholders their dividend, that which remains normally belongs to the ordinary shareholders. Listen, your company can decide to pay all of that 148 as dividends ordinary, or your company could decide to retain all of it as retained profit, or your company could decide to pay half of it as dividend and retain the other half as retained profit. It is obvious whether the company keeps the whole amount of 148, it's still an amount belonging to ordinary. Whether the company wants to pay it, all of it as ordinary dividend, it's still belonging to the ordinary. Whether the company wants to pay half of the amount as ordinary dividend and the other half to retain, it still belongs to ordinary. So in other words, I'm saying this 148 million is an amount that is attributable to the ordinary shareholders. Now, this question did not tell us what proportion of dividends are to be paid to them. Some questions tell you the company decided that they'll be paying a rate of 30% of the profit as their retained profit, or they retain 30% of the profit as retained. This question did not tell us anything. So we shall be required to stop there, but we shall say this is profit attributable. This is profit attributable to ordinary shareholders. So these are kind of a distribution. Listen carefully before we put it down officially now. These are kind of distribution the examiner expected you to present. They are saying, we expect to make a profit before interest and tax of 300 million. Then the question told us, show or prepare a distribution statement of the anticipated profit, showing how it will be distributed to who? To the various providers of capital. One provider of capital are the debenture holders. What are they getting out of 300? They are getting how much? They are getting this 50. The other providers of capital are preference shareholders. How much are they getting? 27. The other providers of capital are who? The ordinary shareholders. How much are they entitled? 148. So the question wanted you to show how these various providers of capital are sharing or will share that 300,000 or 300 million. Now we can put down that statement officially now. Now we can put it down officially. So let's put down, Sema somewhere, put down this, a statement showing how, put it down, a statement showing how the anticipated profit, a statement showing how the anticipated profit will be distributed to the various providers of capital. A statement showing how the anticipated profit will be distributed to the various providers of capital. Now let's put it down officially. You come and say your profit. Maybe I can put it in, okay. Profit before interest and tax. Our figures are in shillings million, so I put it 300 million. Then we less debenture interest. We saw our rate of interest is 10%. Our debentures were 500 million. Don't forget our figures were in thousands, so 500 million. That came to 50. That gives me profit before tax. We have paid interest, so we are remaining with profit before tax of 250. Then I come and say your tax, that is 30% or 250. We have seen it a short while ago, 75. That gives me profit after tax, 175. That's what we have seen. Then I've told you, you less preference dividend. They should be paid first. What's the rate of dividend? 9% on what? Their capital was 300 million, so they are going to get 27 million. Then we got this as 148 million, and I told you this is profit attributable to ordinary shareholders. 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 Okay, so we are through now. Somebody's getting total assets of 244. Where? Let me take you back. Somebody's asking a question in the chat. Okay, finish copying first. Finish copying first, then we shall confirm that. We shall confirm that. So finish copying. We want to confirm something somebody's asking in the chat. Okay, I hope you have copied. So that's how it will be distributed. There is somebody called Sharon who is saying he has got a different amount of assets from ours in the balance sheet. So we want to confirm whether we are right. Somebody by the name of Sharon is saying he's got a different amount in the asset for the balance sheet. So let's go back and see whether we are still right. Maybe she has copied one of the figures wrongly. These are our assets now. Our land is 777. First, Sharon, you confirm. Confirm your figures now. You have 435 as your furniture. You have motor vehicle as your 45. You have inventory was 250, I think so. I think it was 250. Let me confirm. Don't panic. We shall just know. Inventory 210. Where? 210, not 250. 210. Maybe that's where we are differing. I don't know. We shall confirm. 210. Then trade receivables for 939. Let me repeat the addition. Let me repeat the addition. I'm getting 777 plus 435 plus 45 plus 210 plus 939. I'm still getting the same, Sharon. So maybe you are wrong somewhere. Maybe you copied one of the figures wrongly. It could be the inventory, by the way. It could be the inventory because if you add the 40, because you are getting an extra 40. If you are getting the 40, maybe you took it as far to 50. So make that correction. It was 210. Make that correction, Sharon. The inventory is not 250, but 210. Sour. Good. Oh, you had 250 sour. Okay, fine. So maybe for now we can stop there. Maybe for now we can stop there. We pick it up from there. Next time, we pick it up from there next time. We are through with that question now. We are through with that question. So next time we go to what we call external reconstruction. Next time we go to what we call external reconstruction. Now, but before we leave, listen, before we leave, we have some new students. We have some new students. Some of you as new students may wish to join us for the remaining part of the syllabus. Or if you want to join the normal class now, if you want to join our class for advanced financial reporting, I'm talking to the new students now, we have either early morning or evening classes. Our early morning normally starts from 5:30 in the morning to 7 in the morning, every Monday, Wednesday, and Friday. If you choose early morning, 5:30 in the morning to 7 a.m., Monday, Wednesday, and Friday. If you want evening classes, this is evening, sorry. If you choose evening, our evening classes are from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Okay? Our system is such a way that in case you miss a class, for whatever reason, then you can still go back to the group where the link was posted and you can watch the video at your own free time. That's important to know, that in case you miss a class for whatever reason, don't panic. You can go back to the group where the link was posted and you can watch your video at your own free time. Or maybe you have been taught and you feel you want to listen to your class again, just go back to the group, click on the link, and you'll be able to watch your video at your own free time. Now, if maybe you feel you are not available in the early morning, you are not available in the evening, then you can buy what we call pre-recorded videos. You can buy what we call pre-recorded videos, where you get all the videos for the whole syllabus at once, and you'll be able to listen to them at your own free time, at your own pace. Okay, good. For either normal classes or for the pre-recorded videos, we are charging 4,000 shillings, but one can still pay on installments. One can still pay on installments. Now listen. If you are interested in either of them, that is either the early morning or evening, or even the pre-recorded videos, you can call me on this number, 0722 65 8875. 0722 65 8875. We can make arrangements. Of course, I'll give you the videos of the classes you have already missed. I'll give you the videos of the classes you have already missed. Good. Now, some of you again who are here have friends who are doing financial reporting of the intermediate, or what used to be called section 3. We also have classes for them. So if you have a friend who is doing financial reporting, then the classes are normally every Thursday, Thursday, and Friday. Again, from 8 p.m. to 10 p.m. Same system. If they miss a class, they can still watch the video of the class they have already missed. Good. We also have financial accounting for those who are doing foundation level, or who are doing, this is foundation, or who are doing ATD 1 or 2. Again, there is financial accounting there. We are still teaching it again. So if you have friends who are doing this, they can either buy the videos or join the normal class for the financial reporting. Good. So if you're interested, for you, call me on that number. I want to appeal to you again, all of you, please subscribe to my YouTube channel. Please subscribe to my YouTube channel. If you have not subscribed, just click on that button to subscribe, and also click on the notification bell. Click on the notification bell. Good. So let me wish you good night for now. See you next time. Unless there is a question, maybe we can say see you next time. Okay? Bye for now. See you next time. If you are interested and you are new, you can call me on that number, 0722 65 8875. Good. Otherwise, good night. See you next time, where we shall now start with a new topic now. Good night. Good night.